So, welcome everyone. My name's Dan Ryan. I'm the chair of the member interest group on mortality and longevity in the IFOA. And together with the member interest group of the Longevity Catalyst, we have decided to put together a platform to enable actuaries and indeed those outside the profession to have an opportunity to have good discourse on a range of different topics relating to mortality and longevity. And today is the day of the first webinar from this group. And I'm delighted to be able to hand over to Michael Anderson, who will be the moderator for today's webinar. Michael, over to you.
Thank you, Dan. And just to echo your welcome to everybody, it's great to see so many of you able to join us today. Before I introduce our two speakers, I'd just like to make a couple of housekeeping points. Firstly, you'll have noticed that everyone has joined as viewers only, so you are muted and we're not able to see you. So the way to ask questions is using the question function, which you should see on the ribbon at the bottom of your screen. Please do so as we're going through the presentations, but we'll be answering your questions at the end. You can vote for questions that you'd like to see answered to increase the chances that we'll be able to address those during the session today. If we do run out of time though, we're hoping to continue the conversation on the member introduced group website, and a link to this will be provided after the webinar, together with the link to the recording of this session. Just to highlight again that the session is being recorded so that you're aware of that when posting your questions. You can post them anonymously if you wish. So I was introducing our two speakers, and we're very fortunate today to be joined by Steve Bale and Dr. Stephen Richards. Steve is a senior actuary at Munich Re's UK Life branch, where he focuses on basis innovation and predictive analytics. He's also a member of the CMI's Mortality Projection Committee and is the chair of the CMI's COVID-19 Working Party, in which capacity he's going to be speaking to us today. Steve's also joined a small group of volunteers who've supported the government's SAGE advisory group through the publication of a model and paper assessing the impact on excess deaths from bed capacity during the pandemic. Dr. Stephen Richards is the managing director and founder of Longevitas, which is a specialist provider of mortality analysis for actuaries. He's also an honorary research fellow at Heriot-Watt University and has published widely on many aspects of mortality modeling, both for setting best estimate assumptions as well as risk and capital modeling purposes. So without further ado, over to Steve Bale to begin the presentations.
Hello everybody, and I hope you can, I trust that you can all hear me. So today I'm going to I'm going to present some of the CMI's work on analysing abnormal mortality experience. I'm going to cover, I'll cover initially the state of the pandemic, the state of where we are, some of the CMI's work, and then I will move on to some of the metrics, the different approaches we can use for potentially assessing abnormal mortality experience. So this chart effectively shows the state of play today. It's part of a series of information that the CMI publishes on a regular basis, usually every Tuesday. I'm part of a group that signs off on this. For those who aren't familiar with it, sorry, we regularly monitor mortality. So I'm hoping you can see a chart showing standardized mortality across the calendar year from 1st of January through to 31st of December. By calendar year from 2011 to current year. What you can see is, sorry, this is for the England and Wales general population. I think we're quite sort of blessed and spoilt in this country in that we can get death reporting information out, published by the ONS, with typically a 2-week delay. And so this enables us to really sort of track trends at the wider general population level. 2 lines really stand out on this chart. You've got a blue line representing 2020, when from pretty much the beginning of April, you see mortality, the standardized mortality rate, standardized by age, increase quite rapidly relative to the average over the last 10 years. So you see that increase rapidly over the time period of the first wave. You then see it sort of reduce, settle down a bit. We actually had quite light mortality in Q3. In fact, the lightest it's been for quite a few years. And then we had the second wave start pretty much going into November, and then carrying on into 2021. So mortality for 2020 was about just over 7.5% higher in mortality terms. In mortality improvement terms, year on year, it was minus 12%. And then 2021, the black line, the thick black line, we have data up until the 19th of February. The second wave has continued. It's starting to slow down, and we're starting to see some potential positive news, and that when we look at excess deaths by age, we can see some significant reductions in excess deaths at the older ages. And maybe that's a good initial sign that the vaccine rollout program is doing what we want it to do. So that's good news. So what I presented on was the general population on the last slide. So on this slide now, we're actually going to turn to the annuities data set that we published towards the end of last year in working paper 140, where we looked at mortality rates for annuities population for the first 6 months of the year. And what we've done is we've standardized it, age standardized it, so that we can compare it against the general population. So it's our first real measure, insights of how insured lives would compare to general population. And hopefully what you can see is general population and annuities experience mortality rates tend to move together, pretty stable sort of throughout, and then hopefully you can see the spike around April time, jumping up but then starting to reduce around June, July time when the first wave started receding. We naturally expect England and Wales general population mortality to be heavier, mainly because annuities population are on average more affluent, so hence we see the lower mortality rates. More information on that is in working paper 140, and we're actually looking to do a lot more interrogation on this data set this year, looking at socioeconomic mortality differences and other analyses. And the COVID Working Party was set up in around June in response to the pandemic. The CMI very much saw it as being absolutely critical that we provided subscribers and the general public with information, but equally where a lot of questions were coming in from subscribers, typically about, okay, so how do we deal with abnormal data? What might we have to consider for our best estimate assumptions for our base mortality and morbidity, but then also future trends? So we provided additional guidance in that areas. We also provided some high-level thoughts around measuring uncertainty around best estimate, as well as considerations for CMI committees. What should they be centering, focusing their attention on? And working paper 139 came out early October and summarises those 4 elements. today, I'll be focusing on that first bullet point on how might we adjust, or assess experience under different methods when mortality is abnormal. So in our working paper, we chose to focus on 4 main metrics for A over E, so actual claims over expected claims. We focused on mortality related experience, and the 4 main methods are really, first of all, the crude result. So what experience are we seeing without any adjustment? We then considered what might happen if we removed COVID-related deaths from the actual claims. We also considered what might happen if we, instead of adjusting for the COVID-related deaths, we actually made an adjustment for excess deaths. And with that, we probably have to consider what excess deaths meant in respect of insured lives. And then as a 4th measure, we can take historical experience and we can roll it forward with a sensible mortality improvement for 2020. So I'll be focusing on the first 3 measures. But before I do, I think it's important that we consider carefully the features of the lives that we typically analyse as part of our portfolio studies. Insured lives do have different features, different characteristics compared to that of the general population. And so I've listed some out on this slide 6. Further information is set out in the working paper. So I'll run through them very quickly, but for portfolio makeup, absolutely consider the features of the portfolio that you're analysing by age, because COVID, in terms of mortality outcomes, has been predominantly very much sort of high age. Certainly over age 60 has been where most of the deaths have been centred. So age and gender, socioeconomic mix. Should consider the impacts of underwriting. Lives that are medically underwritten, typically you're underwriting and managing away potential excess risks, pre-existing conditions which might impact, which might in turn have resulted in a COVID claim, COVID-related claim. Likewise, for guaranteed acceptance policies, typically there's a moratorium period of the first couple of years, where typically only accidental death benefits are paid out, and typically also return of premium. So typically from a new business perspective, it might be that actually impacts might be a lot more limited than, say, a large mature portfolio, where the impacts of underwriting may have worn out. That selection impact may have worn off over time. I've touched on socioeconomic. Depending on the affluence, you could see a different level of mortality. Other areas to consider: IBNR. Is IBNR driving any changes in experience around sort of collection of information, collection of medical information, the quality of that reporting during the pandemic, particularly in the early stages of the first lockdown? Persistency. Has there been any changes to lapse or customer behaviour around that? High age mortality, I've touched on already. Older lives typically tend to be where deaths are centred. And then just really the last point around credibility. Typically, when we're assessing how much credibility to place on an experience, we'll typically assess it relative to the number of claims. And it may well be, if we're using a claims number that includes COVID claims, we could run the risk of overstating credibility applied to that data set. So I'll quickly run through sort of each of the options and some of the features to bear in mind. So we'll talk around, first of all, should we ignore the data? We could choose to actually ignore data for 2020 completely. And potentially this could be a fair or reasonable approach if actually we think future years could return to normal levels and very quickly. So if it's just seen as a blip year, we might choose to exclude without feeling there's a loss of information there. But there is a genuine challenge with this, in that what happens if we have further years of abnormal experience? And certainly where we are in 2021, with that second wave continuing into this year, we're probably going to see a bit of abnormal mortality carry on in the short run. We might see a jump around of deaths if deaths have been accelerated due to the pandemic. And then we need to think about what the impact of future indirect deaths, if any, might occur. And really this comes down to, in the first lockdown, the NHS reprioritised its activities, its core activities. And there's been a lot of concern around misdiagnoses, miscritical diagnoses and treatment as well, particularly around cancer diagnoses and cancer treatment with chemotherapy being postponed. So there is a concern of future direct deaths starting to come through in the future. So maybe ignoring the data might not actually be the best way to go about things. So another option is that we could actually just remove deaths specifically linked as COVID-19. And actually, if the data is available and there's good reporting, then we could reduce the actual claims and hence the A over E. It is dependent on that availability of good quality data and understanding it. So first of all, it needs to be available. And particularly when it's one thing the CMI we've looked at is what data do we have available? We're talking to all our data contributors, understanding the reporting mechanics for protection as well as for pensioners. Probably the area where we're going to struggle to get data around COVID related deaths is going to be regarding pensioners' annuitant mortality. That data we understand is not being collected by scheme administrators. We also need to, when we're talking about good quality data, what really is a COVID-related death? Was it that someone had a positive test for COVID and then died? Was COVID the main dominant factor, or was it a contributory factor? And also, how is a COVID, so given that the definition changes over time and that sort of level of detail, there is the potential to either overstate or understate experience. So overstating, and this happened particularly early on in the first wave, if deaths are not being attributed to COVID accurately, and that happened when we didn't have a robust reporting system set up in the first wave. But equally, you could understate if COVID hadn't been that primary contributor to death. And then the third way, which I think is getting a lot of traction, mainly because of the challenges on the last slide, is really around excess deaths. Certainly, we at the CMI feel that excess deaths is the way to go. is our preferred approach, mainly because of all the challenges we just discussed on the previous slide. We have the general population deaths data. I say it comes with broadly a 2-week reporting time delay. So based on that, if we use a reference population, we can calculate excess mortality. And then given our own specific portfolio's exposure, we can multiply the excess death rates by the exposure to calculate excess death rates, which can be then used to adjust our analyses. So I say we think it is our preference, as it does remove some of the subjective elements. There is still a subjective element to it, in that we need to think very carefully about do we need to adjust the excess deaths to reflect the portfolio that we're working with? So particularly by age, rates by age, gender, a socioeconomic mix, potentially geographical as well. And as well as also considering what's the makeup around the insured life duration that I discussed earlier, and the impacts, the selection effect from medical underwriting. The choice of benchmark could, in determining the excess deaths, may also impact the outcome. So for the CMI, we've chosen to use 2019. We have to pick a pre-pandemic year. Typically, we like to compare experience to the previous year, so we chose 2019. The ONS, on the other hand, they typically use a 5-year sort of rolling average of experience. There are challenges with the two different methods. There are pros and cons. And 2019 had an earlier and a bit higher flu season in Q4. The ONS approach doesn't really allow for an aging population. But by and large, the messages, by and large, should be broadly similar. So I'll be handing over to Stephen in a minute. I think the key takeaways that we've got is really, we think that there are a number of ways that people can analyse experience, and they're the ones that you can adjust your actual claims, you can allow for excess deaths. We think that when it comes to ignoring or sort of using data for 2020, we think there is value for analysing the data, and we're looking very much this year to accelerate our deliveries across all of our different experience analyses, not just to show how experiences move relative to the general population, but actually to apply these metrics and to dig further into providing insights for our subscribers. And we are looking to provide a paper, probably the late Q2 or Q3 of this year, to dig further into the annuities data set that I presented much earlier on, because this will provide a real life example of how we apply these metrics. And that's it from me for now. Over to Stephen.
Thanks, Steve. My name's Stephen Richards. Hopefully everyone can see my screen now. I'm going to look at mortality shocks in some annuity portfolios. My presentation very much complements Steve's. I will focus on the annuity portfolios of 3 countries. So I'm going to look at briefly some background on COVID-19 and its impact on mortality. I'll look at the 3 annuity portfolios for which we actually have data across 3 different countries. I'll then look at a non-parametric approach to looking at the extent of the mortality shock in these 3 portfolios. That will then raise the question of reporting delays. How extensive are they, and what's the impact of them? I'll then look at a parametric approach to looking at the mortality shock, looking at the extent to which we can allow for reporting delays in our analysis, and in fact use our model for reporting delays to enhance the non-parametric approach. And then we'll conclude. So we'll look briefly at some features of COVID-19. So that's the name given to the disease caused by the novel SARS-CoV-2 virus. As will not have escaped anyone's attention, COVID-19 is often fatal for some people. So here's some data from Spain and Italy early on in the pandemic. So this is the first wave of mortality in May and April 2020. This was some of the early stage data available by the late spring, early summer. And we can see here a number of important features of COVID-19. There's a very clear gradient with age. These are infection fatality rates. So these are confirmed infections. And then there's a binary outcome, survival or death. And we can see a very strong progression with age. Down at age 30 or below, there's only a 1 in 1,000 chance of dying from a COVID-19 infection, whereas for Italian males at the start of the epidemic, over age 90, there was only a 1 in 2 chance of surviving a COVID-19 infection. So a very stark progression with age. Very similar patterns between Spain and Italy, and this particular age pattern was also echoed with some of the early data that came out of China around about January, February in 2020. Another important aspect is that there's a persistent excess male mortality for a confirmed COVID infection. So males have higher mortality rates from a COVID infection than females at all ages, and for both Italy and Spain here. So we can see, as Steve alluded to, depending on your portfolio, you can have some quite large impacts if you're insuring older ages, and potentially more modest impacts if you're insuring younger ages. So COVID-19 can be fatal, and the impact varies by age and gender. The other feature of COVID-19 is that its arrival became immediately obvious in national mortality statistics. So Steve talked about the usefulness of the excess deaths measure. So here we followed the ONS approach of measuring the deaths, the weekly deaths in 2020 as a percentage of the average weekly deaths in 2015 to 2019. So we've got Italy and England and Wales on screen. And for the first couple of months, the 2020 weekly deaths as a percentage of the previous 5 years was pretty much 100%, more or less. And then when COVID-19 arrived in each country, we had a mortality spike. What both countries show are that the wider population showed a spike peaking at around 200% of normal mortality during April. But they also showed a high degree of localization. So London had a spike nearing 350% of normal, whereas Lombardy in the north of Italy had a spike that peaked at close to 400% of normal. So the COVID mortality became immediately apparent in mortality statistics at a national level, but with some quite pronounced regional concentration of the impact. What's also interesting, obviously, is that the Italian, we've got the 1st of April marked here with the dotted lines. So the Italian pandemic peaked during March. It arrived in Europe first, but the mortality peaked during April in England and Wales. So it took a little bit of time to get from Italy across to England and Wales. So we can see here from the national statistics that the COVID mortality shock was really quite intense. Anything that doubles your background mortality rate is really very significant indeed. It was also very short term. So the actual spike is actually measured in weeks rather than months or years. and it can be intensely localized. We've got some very strong geographical concentrations in excess mortality for certain countries. So the obvious question then here would be, how might this, or how did this, impact annuity portfolios around the world? So to do this, we'll look at the data we've got. So we're very fortunate that 3 insurers supported our research and shared data for an annuity portfolio in France, 1 in the UK, and 1 in the USA. And they're all relatively large portfolios. So we can see here the in-force annuities at the 1st of April 2020. And we've got a fairly large number of deaths in our mortality data. So we've got some fairly large portfolios with fairly substantial amounts of information. These are the average ages of the 3 portfolios. So we have different periods. So the US portfolio, we only have 3 years of data, whereas the French portfolio, we have actually 20 years of data. So this is the average age over time. And we can see that the French portfolio is markedly younger on average than the other 2 portfolios. So from our previous slide, we might expect the French annuitant portfolio to be less strongly affected by the COVID shock because of the younger average age and the lower mortality rates from COVID infections at younger ages. It's also worth commenting on the step jump for the UK portfolio. This is where a large block of annuities was reinsured out of the portfolio. They reinsured the younger age annuitants out, which increased the average age of the remaining annuitants. So those are our 3 portfolios. They're still open to new business in the main. They're still writing new annuities. But as you can see from the increasing average age, the new annuities are not balancing the deaths in portfolios. So we're going to look at a non-parametric approach. We'll first define some of the things we're going to look at. So mu-x is our usual force of mortality at age x, and the function lambda x t is what's called the integrated hazard. So that's just the integral or the sum of all the forces of mortality from one age to the next. Now, as is usual with mortality analysis, we normally define mu-x and lambda x with respect to age. But the question here is, what might happen if we instead define things with respect to calendar time y? So we'll take an example. This is the UK portfolio, and we tabulate the individual dates. This is just one particular week in June. And then we look at the counts of deaths that actually have been notified on that particular date. These are not the dates of notification. These are the actual dates of death. And what we do is that we ignore dates where nobody died. So we're only interested in dates where 1 or more deaths take place. And then we calculate the in-force policy count at the start of each date. So we've got dates of death, the numbers of deaths, at least 1 occurring, and then the number of policies that go with this. So we've got our deaths and lives, and we can use this to calculate our simple QX rates. So we'll change our notation, and we'll just denote by y plus ti is basically the individual dates of death where there's at least 1 death occurring. The d's are the equivalent counts of deaths on that particular date. And then the l's are our usual life table number of lives in force. So we've got y plus ti as our set of distinct dates of death. The dy plus ti's are the number of deaths occurring on those dates. And then the L minus numbers are the number of lives alive immediately at the start, immediately before that particular time, y plus ti. And what we can do then is that we can calculate this estimator lambda hat with respect to calendar time now instead of age. and it's just the sum of these crude QX rates, D over L, for each individual date or time for which we actually have one or more deaths. And we sum all of these up to a particular point T, and this will give us an estimate of the integrated hazard with respect to time instead of age. Now, what does this look like? Well, it's one of the most boring graphs you're going to see today. It looks pretty much linear. This is for the French portfolio from 2010 to the start of 2020, and it looks pretty much like a straight line. So lambda hat on its own is near linear and really rather boring. So one question might be, what about taking first differences? So what we do is we estimate mu hat. So this is the mortality at a broad portfolio level with respect to time, y plus t, is just going to be the first central difference around time y plus ti. So we've got the integrated mortality hazard c over 2 years ahead, take away the integrated hazard c over 2 years prior. And we divide this by c itself, which is just a bandwidth parameter. We can set this according to how heavily we want to smooth. So we might use a value of 0.5 years for a fairly heavy amount of smoothing. If the portfolio is large, then we'd be able to reduce the value of C, apply less smoothing, and actually see maybe more detail. So this gives us a non-parametric or semi-parametric way of looking at overall portfolio mortality levels. And this is what we get when we apply this to the French portfolio. That dull straight line has actually revealed an awful lot of rich detail. So the first difference is showing quite a number of important features. The most obvious one are the recurring annual winter peaks in mortality. So these peaks here are all December or January in the relevant years. And we've got the corresponding summer troughs in mortality when mortality rates tend to be at their lowest. So these are, if you like, the hazardous winter peaks driven often by excess cardiovascular mortality and especially flu and respiratory disease mortality. We also have an increasing amplitude from peak to trough from left to right, and that's because the portfolio is aging. The average age is increasing over time, and older people are more susceptible to excess winter mortality. So that's why the amplitude of the peak to trough is increasing as we go over time. The general level, of course, is increasing over time. That's not because mortality levels are increasing or because improvements are negative. That's simply a reflection of the increasing average age of the portfolio. And on the right here, what we don't have is a collapse in mortality rates here. This is basically just the impact of delays in death reporting. So the most recent reported mortality rates are less reliable, and we have underreporting of deaths here, which is why the estimator is so low here. So we have this non-parametric estimator, capital lambda hat, which is near linear. But by taking first central differences, we can actually reveal quite a lot of rich detail about seasonal patterns in particular, which then raises the question, can mu hat reveal the COVID-19 shock? And the answer is yes. So we have here the French portfolio. This is the non-parametric estimator with a smaller smoothing parameter here. And we can see 1st of April is shown. We've got this COVID spike here just after the 1st of April. And we can compare this with past seasonal spikes in 2019 and especially 2017. So it's worse than, if you like, the winter spikes, but not massively worse. The UK portfolio, in fact, the COVID spike is a lot worse than the previous winter spikes. This is partly due to less delays in death reporting, but mainly because of the higher average age and therefore the greater susceptibility of this portfolio to COVID mortality. And then finally, the US portfolio. There's only 3 years of data, and the lines are somewhat smoother and less spiky because of the sheer scale of this portfolio. But we've got our summer troughs as expected, and we've got our winter peaks. And then we've got the winter peak in 2020, closely followed by a very pronounced COVID spike in April. So we have the situation here is, although the national data for Italy showed that their COVID peak was earlier, maybe a month earlier than in the UK, what we've seen here is that the COVID shock hit this French, UK, and US annuity portfolios at pretty much the same time, all peaking in early to mid-April 2020. It's worth pointing out a couple of aspects of this non-parametric estimator. To calculate it, we only need 3 bits of information: the date the annuity started, the date the annuity terminated, and whether the annuity terminated due to death or withdrawal. A critical aspect of these 3 pieces of information is that they do not constitute personal data. So to calculate this non-parametric estimator, you require no personal identifying data at all. And that means that privacy and data protection rules don't apply. So depending on your territory, whether UK, EU, California, or Canada, the nature of the data required is such that it's privacy safe. So we've got some advantages of this non-parametric approach. It reveals clearly the seasonal variation. It reveals the extent and timing of the mortality shock in the portfolio. And it doesn't need any personal data, which makes it privacy safe. But there are some drawbacks. One is that smoothing, by definition, will understate the extent of a shock. If you have a spike upwards and you're applying any kind of smoothing, then the larger the smoothing parameter, the more you will end up flattening the spike and possibly understating the extent of the shock or the peak. It's tricky to separate the shock from the background seasonal effects. The nature of the nature of the COVID spike is so short-term and intense, applying over a couple of weeks, that it can be difficult to separate what is the COVID shock and what was the background level of seasonal mortality. A big drawback of the non-parametric estimator is that it doesn't allow for any key risk factors like age or gender, although you could partition the portfolio as I did in the accompanying paper. So I'd calculated it separately for males and females for the UK portfolio to show that the COVID spike hit the males in the portfolio harder than the females. And again, related to smoothing, the non-parametric estimator is not defined for the most recent C over 2 years. So the more smoothing you apply, the more that you'll lose in terms of insight to the most recent experience data. And obviously, as we saw with the French portfolio, we're affected by reporting delays. So we'll look quickly at reporting delays. So this is the same week in June 2020 as before. So we've got the view according to an extract of data taken in June 2020. And then we've got the view of the same week according to an extract taken in September. And obviously we have a lot more deaths have occurred on those dates and have been reported to us. So we've got this big difference in the numbers of deaths, which were basically deaths which had occurred but not yet been reported by the time of the June extract. And this has obviously impacted on the death counts, but also on the in-force counts as well. So we assume that we've got 2 extracts at times U1 and U2, June and September. And we assume that a death occurs at some point before the June extract. And there are actually 3 possible situations. So we've got our extract at time 1 an extract at time 2, so this will be June and this will be September, and death has occurred at some point before the June extract. And in case A, death has occurred and is in fact notified before the first extract is taken, so we know about this death in June. Type B cases would be where the reporting delays are at least 3 or more months, so that in fact that it would not in fact be notified until sometime after the second extract. And then type C deaths are ones that are notified after the first extract is taken, but before the second extract. So we don't know about them in the first extract, and we do know about them in the second. So type A deaths reported by the time of the first extract. Type B deaths we still don't know about, even at the time of the second. And then type C deaths are the ones reported between the extracts. Now, types B and C are what are called occurred but not reported, or OBNR. And this is similar to the term IBNR, incurred but not reported, which is usually used to refer to general insurance claims. Now, the distinction was actually made by a researcher called Lawless, because we're actually purely interested in the delays in reporting, whereas IBNR is usually used in general insurance for a combined delay and claim reporting, or delay and cost model. So what we can do is that we can calculate our non-parametric estimator for a given time, and then we can calculate it once using our extract in June, and then again using our extract in September, and we calculate the ratio of these two estimates, and they'll be close to 1, where we've got minimal impact from reporting delays, and obviously it will decay down to 0 possibly as late reporting delays affect the mortality estimate. So our OBNR impact should be negligible when R is close to 1. And this is what it looks like for our French and UK portfolios. And sure enough, if you go far enough back in time prior to the June extract, the ratio is close to 1 and there's negligible impact from reporting delays. The closer you get to the extract date, the ratio starts to fall towards 0. So here, it's not defined for the month or two just prior to the extract, but we can see here we've only got about 75% of deaths reported in the second month before the extract for the UK portfolio. And we've got a far more dramatic late reported death situation for the French portfolio, with the OBNR impact really quite considerable for up to half a year back from the extract. So our reporting delays affect the most recent mortality estimates most of all. The strongest impact is within a quarter year of taking the extract, and there's minimal practical impact 3/4 of a year or more before the extract date. So we'll now look at some parametric modeling. So we'll look again at our ratio measuring the impact of OBNR. So R is our ratio of the portfolio mortality in June and the portfolio mortality in September. And what we'll do is we'll reword this and just say that there's some ratio rho, which is our OBNR affected or our delay affected mortality estimate divided by the true underlying estimate once we have perfect information and all the deaths are ultimately reported. And what we can do is we can then rearrange this as follows and say that our delay affected mortality is just the true underlying mortality times this ratio rho, which will vary from 1 down to 0. So this gives us our model, and we can actually do statistical modeling with this. So we've got mu OBNR is what has been reported to us in terms of mortality. Mu star, which is the actual underlying mortality experienced that we've yet to be informed about. And rho is our scaling factor for late reported deaths in the time up to the extract, with this parameter lambda 1 which is our OBNR decay parameter. So we've got a number of options here. So we get 3 potential options on screen for our functional form for rho for this OBNR function. We can pick this depending on the timing and extent of reporting delays in the portfolio. So we can make our choice portfolio specific. And this slide shows the impact of the OBNR decay function. The lower the value of lambda 1, the further back the impact, the more pronounced and the further back the impact of the delays actually stretch. So when lambda 1 is 1, we've got a lot of OBNR impact, and a higher value of lambda 1 means a much smaller impact that tails off very, very quickly. Note that the horizontal axis is reversed, so we're measuring time backwards from the extract date, and this is mortality scaling in years before the extract date. So this gives rise to 2 questions for forecasting. The first one is, could we use a model using data extracted at time U1 to predict the unreported deaths that are heading our way? And can we use this OBNR function to adjust for the unreported deaths in our extract and improve our picture of current mortality? So the answer to both is yes. So in the first case, we look at the Gaussian OBNR function fitted to the data for the French portfolio using the June extract. So this solid gray line is the extrapolated or the implied delay function just from analyzing the mortality up to June 2020 with this particular estimated value of the decay parameter. And then the jagged line is the previous ratio of the mortality in the run-up to the June extract using the September extract as a proxy for the true ultimate underlying mortality. And we can see here that the implied function just from using the mortality experience to June 2020 has given us a very workable estimate of the mortality reporting delays. It's got roughly the right shape and instance and timing. So it's a surprisingly effective forecast. Now, the crinkly line obviously lies out with the 95% confidence intervals, but as a broad brush adjustment, the OBNR model has largely worked. So how might we use this? So returning to the French annuitant portfolio, this is the non-parametric estimator calculated using the June extract. We've got our previous winter peaks, some quite dramatic winter peaks in the past, and no evidence of either the winter peak for January 2020, or little evidence of it, but no evidence whatsoever of any mortality spike from COVID-19 mortality. And this is because even at June 2020, the deaths from April had not been fully reported by that time. What we can do then is we can use the fitted OBNR function from the June extract to allow for the unreported deaths and then provide an improved estimate of the non-parametric estimator. Now this time we can see an estimate of the true winter peak, and also we've got sight of the pending COVID spike. Just to contrast, so this is the actual raw data as of June 2020, and this would be the prediction of what's coming the insurer's way in terms of unreported deaths, just by allowing for the mortality reporting delays evident in the June extract. And then to complete it, this is the actual picture in the September extract, where we've got our COVID spike in April. Now, if we contrast the previous 2 pictures, then we can see that the OBNR adjusted picture in June has slightly overstated the winter peak, and it's got the precise timing of the COVID peak slightly wrong. compared to the actual data, but as a forecast based on incomplete information and missing data from reporting deaths, then the OBNR adjustment has actually been quite effective for predicting for the insurer what deaths were actually going to head its way. So to conclude, the COVID-19 shock is detectable in all 3 annuity portfolios. In the 3 portfolios in France, UK, and the US, it peaked at pretty much the same time in the first half of April 2020. And we've got non-parametric methods that we can use to detect this. They're very useful for communicating with non-experts, and they're also privacy safe. We have a drawback that reporting delays are a major barrier for analysing the most recent mortality experience. However, we've got a parametric model that we can use to allow for these delays, and then not just adjust our non-parametric estimators, but also provide short-term forecasts of unreported deaths that are heading our way. I got some references here, which includes the paper on which these slides are based. This is available on the website right now. At this stage, I think I will conclude, and we have time for questions.
So thank you, Stephen, and also to Steve for 2 really interesting presentations. A lot of food for thought in there, especially for those of us thinking about our experience studies that we'll be carrying out during the course of this year. So a lot of good detail there for us to start developing our thoughts around. We do have time for just a couple of brief questions. The first one for Steve Bale just relates to the question of excess mortality and how we define that. And the question is, if we see that being different for a particular age group, the example that's given is if we have negative excess mortality for younger ages due to fewer accidental deaths, perhaps due to less road traffic during lockdowns, would we make some adjustment for that, either in zeroizing that out or in some other method?
Yeah, thank you for that question. Yeah, I think it's a really good one. Negative excess deaths could occur depending on the time period, depending on the benchmark, but sort of given what's gone on with COVID, it's probably more likely to happen at if it's more of an age range element. So younger ages, potentially lower work-related accidents, road traffic accidents, potentially. So I think I'd be looking at the level of that excess deaths. If it's quite low, if it's negative, I'd be actually considering whether an adjustment would be appropriate or not.
I think that makes sense. And a slightly related question for Stephen is thinking about what we might see in terms of winter mortality at the later part of 2020, where we've certainly seen a much suppressed flu season. And so we might be wanting to make some adjustment there, because if we had an excess deaths measure, we would be missing those flu deaths that would normally be in there. So the excess deaths might be understating the COVID-19 impact. Do you think that your non-parametric estimator might offer us a way of making an adjustment for that expected seasonal variation?
On its own, I would say unfortunately not. We've got a very good counterexample of this with our second wave. So the UK experienced a second major COVID spike peaking in January 2021, which is almost entirely coincident with the normal seasonal variation. So on its own, it's impossible to tell what is COVID mortality and what might actually have been ordinary expected seasonal mortality. I think to separate the two, to truly determine whether or not the COVID spike is particularly abnormal, and to properly benchmark it, I think you would need a parametric model that allowed for seasonal mortality. So you could take out the ordinary recurring seasonal effect, and then what would remain would be the pure excess beyond normal seasonal variation. I've done this, and for example, you will see in 2021, January 2021, there's a pronounced more than seasonal spike, but you'll also see past years have also had particularly bad winters. So I think it's 2017, 2019 also have more than normal heavy mortality in winter.
That makes sense. Thank you for that. I see that we have slightly run over time, so perhaps for now, the best thing to do is to thank both of our speakers again for their efforts today, and to just remind everybody that the conversation continues on the Mortality and Longevity Forum website. You'll receive a link to this along with the link to the recording of this website in around 24 hours time. So please do join us there to continue the conversation, and also please look out for the next webinars forthcoming in this series. As Dan mentioned at the beginning, this is just the first in a whole series, so we hope that you can join us for later installments as well. Thank you all for joining us today, and I hope you found that useful and interesting.